every bubble bursts. I am 99.999% convinced we are in a market bubble. It's a price bubble. At some point, the pin will prick the bubble. This is how it's played out over the millennia. And it's the people that have the liquidity that can pick up the pieces at the bottom.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. You know, it's easy to feel confused these days. With the stock market at all-time highs, some analysts predict the bull market has a lot longer to run as the business-friendly policies of the new administration start adding tailwinds to the economy. Others see economic growth as imbalanced at best and worry that overall the trend for 2026 is downwards, risking recession and a material market correction. So, which is it? For guidance, we turn to highly respected economist and award-winning researcher David Rosenberg, founder and president of Rosenberg Research. David, thank you so much for joining us today.
Well, thanks for the invite, Adam. It's great to be on.
Hey, well, great to have you on, David. And as we talked about before we turned the camera on, congrats to your Blue Jays there. I hope everybody in your province there is excited at what the series might hold for them.
Well, it's, Canada is probably not going to win the tariff war, but I think that the hope north of the border is that they'll win the baseball battle. So a small consolation.
Small consolation. And I should note on the day that we're talking, we just had another curveball in the U.S.-Canada trade discussions where I think Donald Trump just walked away from the table because of some ad that ran in Ontario. I'm sure we'll get to this talking about the trade impacts or the impact of these trade discussions, but the surprises are happening in real time here. But to the question that I raised there in the intro, David, why don't we just roll up our sleeves and start right there? Where, in your opinion, is the economy headed here? Do we have a healthy economy? Is 2026 going to be a decent year? Is the momentum that we've had over these past several years, especially in the markets, going to continue? Or will 2026 be a different story?
Well, lots to unpack there. So let's talk about the economy, because when you ask me, is it healthy? I guess it's a case of what your definition of healthy is, and another case of beauty being in the eye of the beholder. The economy has definitely cooled down this year compared to what it was a year ago. There's no doubt about that. If your definition of healthy is that we're small positive growth, and frankly, I don't know how the Atlanta Fed nowcast is as high as 3.9% for the third quarter. But then again, the St. Louis Fed nowcast, which gets very little play, is close to zero, which is where we are. We don't have the government data right now. So the emphasis is on what's referred to as, the soft data or the survey-based data. And we rely a lot on the soft data too. The soft data, you can argue, is more anecdotal than the hard government data. But the one thing we know about the hard government data is that it is also subject to wild revisions. One wild revision cost the BLS commissioner her job, if you remember, a couple of months ago. So I don't bow down to the holy grail of just one number or just say GDP. When we actually run our survey-based models on the economy, and we've got all the survey data across the business sector and across the consumer sector, it actually is pointing to flat growth for the third quarter, notwithstanding what the consensus is or what the Atlanta Fed nowcast is saying. The amalgam of the survey data is telling you that things are as flat as a pancake, or what they say in Quebec is flat as a coup de castor, which is a beaver tail. And we already have Adam, we already have some data points for October. We just got the complete picture for October from the University of Michigan Consumer Sentiment Index. We've got data from various Fed surveys, including the venerable Philly Fed survey, and it's actually pointing to flat economic activity once again for the fourth quarter. So our readings, and we can talk about what the stock market is telling us, but for the here and now, the incoming information when we model it out is telling us the economy is flatlining. And by the way, it's not just us. Look at the Beige book. Look at the Fed's Beige book. It's been coming out since 1970. It's called Beige because the cover is beige. But every 6 weeks, the Fed sends its staff into the field, and they go across the United States, all regions, all industries. It really is the most comprehensive look at the U.S. economy, and we get that every 6 weeks. And we started to run some diffusion indices on the Beige book, and we've also done some data science on it. And once again, it's pointing to a flat economy. So if your definition of healthy is flat, well then call it healthy. In actuality, when you look at the percent share of the US economy weighted by population that's still expanding, that share is 18%. Less than a fifth of the US economy is still in expansion mode when it comes to overall economic activity. 6 weeks ago, that share was over 40%. And the last time that you had less than 1/5 of the US economy in expansion mode, well, you got to go back to the summer of 2020. And before that, you've got to go back to the winter of 2009. I don't think we actually look back at those two periods as the economy being healthy, but I guess when I'm saying that we're flatlining, maybe that's being charitable. But I always look against, my view versus what's priced in. A flat economy is not priced in. In fact, I would say that when you look at the multiples, the re-acceleration of economic growth is actually what's being priced in. And that's where I differ from the consensus. So, in answer to the first question on the economy, call it flat. I think that it'll become more apparent once we get the flow of government data coming our way, once the shutdown ends. It'll end at some point. Nobody knows when.
Hopefully.
Yeah, and look, it's not as if there's nothing positive going on. But the one thing that is positive going on is this AI spending boom, which has been going on for a couple of years and is accelerating. And whatever growth we've had in the economy this year has all come directly and indirectly from the boom in AI spending and the fact that we're building data centers that are the size of Central Park. But when you strip that out, it's so lopsided. The other 92% of the economy that's not AI, direct and indirect, is actually stagnating. I think about the question about the health of the economy. We don't have non-farm payrolls coming out right now. We know that we've had some massive revisions showing that the labor market is far weaker than what was previously portrayed. But we do have the ADP number. And if I'm not mistaken, I think that ADP was down something like 30,000 in the month of September. It's been negative 3 of the past 4 months. So the labor market, that spins off 70% of total personal income comes from the labor market. Well, that's actually starting to contract. So, when I get that question about the health of the economy, because people just look at their Bloomberg terminals and they say, well, look what the stock market's doing. The economy's going to be doing great. But what is more important than the labor market? I mean, is the stock market more important than the labor market? Maybe today it is. I'm not necessarily convinced that it is. But the labor market is clearly sputtering. And what about the other asset class that nobody's talking about, which is the housing market? And I'm not talking about the fact that housing starts and home sales are bouncing along levels that we saw during the Great Recession. I'm talking about home prices, because if you're asking me one thing that's shifted, say in the past 6 to 12 months, is that we have moved from a period of inflation in residential real estate, which is a $50 trillion asset class on household balance sheets. Home prices, and I look at the Case-Shiller index because that is the gold standard for home prices, quality adjusted. It's been negative sequentially 5 months in a row. That is not a blip on the screen. That is a newly established pattern of deflation in residential real estate. And as I said, when I was back in Mother Merrill in the opening months of 2007, when a recession was on nobody's radar screen, I said there is actually never been a cycle of residential real estate deflation of any kind that's ended well. So, we've got this AI boom that has really camouflaged a lot of problems in the other parts of the economy. Capital spending in technology and in AI related, booming. I do sense we're getting into a classic overcapacity stage, which is normal after you've had a inflection point in the innovation curve like we're seeing right now. This is nothing abnormal, but it's really crowded out a lot of investment in the rest of the business sector. And then I said before, housing can't get out of its own way, even with mortgage rates coming down. Commercial real estate is trying to find this elusive bottom. Exports are really doing absolutely nothing, and they have a very powerful multiplier impact on the manufacturing industry. And the manufacturing industry, as you're seeing with repeated isms of below 50, even with the AI boom, is in contraction mode. So it's like aside from all that, Mrs. Lincoln, how was the play? So we have a very, people will argue that the stock market's broadened out. Well, maybe a bit. But when you're taking a look at the concentration of the stock market gains this year, still largely in a handful of stocks. You look at the concentration of earnings growth, which are doing well. Well, again, it's in a handful of stocks, just a couple of sectors. And when you're looking at the broad economy, it's really, once again, very bifurcated. If this AI spending boom ever stalls out, we'll see the economy, what it looks like standing on shore with the tide rolling out, because I would say that there is more profound weakness beneath the surface than is commonly perceived.
Okay, so this is sort of a story then of extreme concentration. We've all heard of the K-shaped economy. You're saying, look, right now the economy is kind of at stall speed. It's going flat, but it's really the AI horse that is keeping it from being negative. We're having all this CapEx spending that's driving enough of that 18% of the economy that's still growing. It's a frightening number, frighteningly small percentage. But that's still keeping us, it's still keeping the airplane level, right? The market, you're basically saying sort of a similar story, largely being driven, I mean, it's at all-time highs, but that's largely being driven by the surge in market cap by the Magnificent Seven, these big AI plays. And then in the consumer economy, you didn't mention this, but I believe it to be true, and you can correct me if this is wrong, but the consumer spending is increasingly being made up for by the top 10%, right? So the people the affluent people who own the stocks in those in those companies that are doing really well and keeping the markets at all-time highs because of the CapEx spending that we talked about, they're still really benefiting, and they're again kind of keeping retail sales at least flat. So it all seems to sort of revolve around this access of AI CapEx spending. And as you mentioned, every kind of technological cycle we've seen where we've been heavily invested in a new technology, you kind of get to overcapacity, right? Everybody gets on the train, they build out all the new infrastructure, and whether it's railroads, whether it's dark fiber, whether it's whatever, they end up having more than they need. And then over the ensuing years, maybe decades, as in the case of the internet, it takes a while for that excess capacity to finally be getting fully used. So I guess the big question here is, so where goes all this AI stuff in the next year? Should we just expect this rising tide of CapEx spending to keep the game going? Or are you seeing any signs that are suggesting that it could start, maybe even if not contracting, just diminishing its growth impulse enough that the weight of the rest of the economy that is not doing so well will start to become a lot more visible?
Well, trying to time the peak of anything is next to impossible.
Yeah.
So, I go back to, I mean, there's differences, but there are a whole lot of similarities to what happened in the late 1990s. And, the recession started in the beginning of 2021. And then, of course, NASDAQ peaked in March of 2000, the S&P closer to September of 2000. And it's never quite apparent when you're at a peak. I thought things were going to start to roll over in 1999, and it kept on going for at least another year.
Right.
I was called a Luddite back then, but so firstly, I don't know if I can answer that question of the timing,
Okay.
or for how this plays out next year. Uh, there's been there's been a lot of spending put into this already. And when you're taking a look at the spending that's been put in, the question becomes, what then will the total addressable market, the TAM, going to have to be to have all this make financial sense?
Right.
And you're really talking about, that you would need to have that market balloon uh, roughly 8 times to a $4 trillion market size and a $30 trillion economy. And that's a sort of arithmetic that ultimately didn't make sense as we were wrapping around fiber optics back in 1999, the early 2000s. It's just knowing the environment that we're in uh, and knowing what's out there without trying to time it, because nothing that you and I do for a living is black and white. It's all various shades of gray. And Baron Nathan Rothschild, who was the smartest and most successful of the Rothschild brothers, famously said several hundred years ago that I didn't get wealthy by buying at the bottom or selling at the peak. I played the middle 60%. So the question is, where are we in terms of that middle
Right.
60%? Like, I think actually, we're talking about baseball before. We're in extra innings. And I was saying that in 1999, and actually we were in extra innings, and it goes back to Bob Farrell's famous market rule to remember that exponentially rising markets go further than you think, but they don't correct by going sideways. So we could have another year of this. I mean, it's quite possible that all the spending continues to roll out. At some point, it will come to an end, and then we got to decide, what really is the rate of return of the invested capital that was put in, and I think that's where the disappointment is going to come, because when you back out the multiple, what is the market telling you? The market's telling you that generative AI is going to be so powerful that it's going to drive overall earnings growth in the economy from now to 2030 at over a 15% average annual rate,
Hmm.
which is double the historical norm. So the question is, some people might say, well, I think it's going to be 30%. Well, then this market is for you. Some people might say, well, it might be closer to 8 to 10%. Well, then we are, even under that optimistic scenario, overdone as it is. And the last time that we had these dynamics, again, was in the late 1990s during the internet boom. And you know what I find very interesting is everybody says, well, it's not the same today as it was back then. Back then, it was all about pets.com. It was about companies with no earnings, no cash flow, no balance sheet, and no prospects. And that was true for a lot of the .coms. But that was the internet wave that engulfed everything. And so you had companies back then with real earnings, real balance sheets, real business models that are still around today, like Microsoft, by the way. At the bubble peak in March of 2000, the biggest stock was not Lucent and it wasn't pets.com. It was Microsoft. And it wasn't no $1 trillion stock. It was over $400 billion.
Mm-hmm.
You didn't even have the same degree of concentration that you have on our hands today, although it was very high back then. But, you know, we had again a situation where a whole lot was priced in, and not just priced in to the flashy concept companies, but companies like Microsoft, these giants that are still here today, Microsoft, Dell, Intel, Cisco, IBM, they all went down between 60 and 80% after the broad technology bubble burst. That was a broad technology bubble. This is a broad technology bubble. Is it as big as that one? I would say probably not, but this is the second biggest bubble on record. And, you know, I guess, you know, Howard Marks was on the tapes, on the wires recently saying, well, you know, you can't really call it a bubble because of the quality of the character of these companies today. Well, you know, you had great companies, as I mentioned before, that do get caught up in a price bubble. The Nifty 50 stocks of the late 60s, these were all tremendous companies. It's a price bubble. And I think that's the point that has to be made. And the question is, what valuation metric are you looking at? And you could look at any one of them. You could look at price to sales, price to EBITDA, price to book, the Buffett indicator. And what I look at the most is the Cape multiple, the Shiller PE, because it's smooth over 10-year cycles. And it's got 100 years worth of data. And that multiple is flirting at 40 right now. 40. We've expanded 7 points in the past 6 months. Last time that happened was back in the late 1990s. But a 40 multiple, when you look at the history, the peak bubble multiple going back 100 years, I mean, that includes 1929. That includes the Nifty 50. That includes the internet. That you typically peak at around 30, and we're at 40 on this multiple. It's only been this high one other time, and it was in the late 1990s. But you know what? The bubble highs, nobody ever wants to call it a bubble because it's a very emotional term and it scares people. So nobody likes to use the word bubble. Jeremy Grantham famously said that a price bubble on any asset or security is when you break above a 2 standard deviation event. 1 sigma is a mania, 2 sigma is a bubble. Well, we've been in a bubble. We've been 2 SDs on the Cape multiple now since the summer of 2024. So it comes down, you asked me before, like, where are we? Extra innings. And this is going further than we think. As for Bob Farrell, this is not anything new. That when people like myself talk about a bubble environment, we're not saying things are going to come crashing down the next day. It's just understanding the market environment that you're investing in. Okay, in the sense that the wind is not at your back, the wind is in your face. And in fact, the cutoff point on the Cape multiple is 35. Anything over 35 historically and consistently in the next 1, 3, 5, 10-year periods, the total return in the S&P 500 is negative across the board. Once you cross 35. And that's around the same time that we crossed into the 2SD event, which we've been in now for, call it, 14 or 15 months. It's not unusual for a bubble environment to last 18 months. That would tell me actually that we're in extra innings, but that les jeux sont faits. Once again, as they say on the French side of the Quebec side of the border, that I think the clock is ticking on this bull market. When you try and time how far you go to a bubble, now you have to have the conclusion or the assumption that we're in a bubble, because your assumptions in our business drive your conclusions. Everything's north of a 2SD event. It's a price bubble. Not a bubble in business models, it's a price bubble. And in answer to your question about 2026, what causes the bubble to burst? You never know. Like, what caused the bubble to burst and this was a housing and credit bubble back in the fall of 2007. Do you remember the exact? I mean, New Century Financial closed its doors. That was the cockroach in January of 2007. Well, the bad stuff didn't hit the fan for 10 months, right? What was the eureka moment back? What caused the NASDAQ to peak? Do you know, back in March of 2000? Because I don't remember. It might have been because you start to hear news that orders were being canceled and that Cisco, God forbid, which was the NVIDIA of the day, missed its earnings, its EPS by a penny. So there'll be something out there, and it's the old saying. It's not complicated. The higher they go, the harder they fall. And it's very interesting, by the way, that in that tech bubble period back in 2000, it was the mildest GDP recession on record. And the mildest GDP recession on record caused a 60% collapse in the overall stock market and an 80% Armageddon in the tech sector. The smallest GDP recession of all time, because the multiple mean reverted as expectations got resolved to the reality and away from all the hope and insanity that was taking place in 98 and 99. I think we're replaying that. I would say on a smaller scale. I think generative AI is massive. The internet to me was bigger, but we can go all the way back. I mean, I don't know if we have to go back to the wheelbarrow from Leonardo da Vinci, but you go back to the steam engine, the cotton gin, the railroads, the canals, electricity, and so on and so forth. Radar. You get these. You get the innovation curve shifting. Investors hop on board. You get the massive CapEx, and what else is happening is that everybody's talking about how this is all being funded off of balance sheets, but it's not. I mean, we know that just so far this year, there's been something like $200 billion of business borrowing in both the private and public markets to facilitate this.
Mm-hmm.
So something tells me that, well, if you're going to ask me, it's probably going to be some sort of credit event. I'm not going to say it's going to be something from subprime autos, which we've seen already.
Yep.
But when they say the bond market leads, people look at the treasury market, which is true. But keep an eye on credit spreads, which are still very tight, but have started to widen out. That's a canary in the coal mine you want to pay attention to. The only thing I know next year that's lining up positive that I know with certainty is that next year is the peak year for fiscal stimulus from the big beautiful bill, which when you add up all the positives and negatives, it's going to add about 50 basis points to growth next year. It's not monumental. Of course, that's no taxes on tips, Social Security, depreciation allowances. It really adds up to 50 basis points. It's not huge, but the only year where the big beautiful bill adds to growth is next year. But there's other things going on as well. How the global trade war cascades China-US relations. Because China, now we know China holds a lot of cards. Rare earths, big card. Magnets. How's this going to play out? Because is Xi Jinping going to give up his cards which are these export curbs on rare earth minerals. And if China continues in that direction, considering how important that is for U.S. military in particular, is Trump going to go through with his 100% tariffs? So that's not going away anytime soon. So we still have the lingering trade issue. And then again, what people don't talk about with respect to government policy is the immigration curbs. And whether you're for them or against them, the reality is that there's only two factors of production. There's labor and there's capital.
Mhm.
And we're constricting the labor supply. I think a lot of the employment weakness we've seen have come out of the demand side, but we know the supply curve is shifting as well. So next year, this year was, you're right, a lot of curveballs. We can see that no matter your view on the economy, it's not strong. But the stock market is strong. But the S&P 500 is not GDP. Next year, I think, is going to be another very difficult year to forecast. I am concerned about what the message is from one particular market, which is the bond market. I'll tell you, talking about a weird year. I'd almost switch roles with you and ask you the question as to if I told you at the beginning of the year that that the 10-year Treasury note yield would rally through Fed funds and go back below 4%. A lot of people weren't expecting that, or that gold, even with the recent corrective behavior, would be up like over 50%. I told you those two things, those two classic risk off factors, that we'd have the S&P around 6,700. I don't know. Would that make sense to you? I mean, talk about divergences.
As I've been
But
saying a lot lately, if you're not confused.
I am nervous. I'll tell you one thing that you'd mentioned before, because and I did too. We talked about the direct and indirect impacts of AI, how it's influenced the stock market. Look, we had the S&P 100 peak to trough in 2022 because of the Fed's aggressive tightening and the inflation. We were down 25%. And we bottomed that fall just as Nvidia and ChatGPT, and that marked the end of that cyclical bear market. But you see, because of the impact it's had on the equity market, you've got this bulge of equity wealth amongst that top 10%. Well, they still do a lot of spending in the economy, even though they don't spend as big a portion of their income as the middle class and the lower income class. It's really, as you said, been dominated by the higher income echelons feeding off their bulging equity portfolios. And in economic parlance terms, it's called the equity wealth effect on spending. And where do you see it? You see it in the personal savings rate, which is nosedived between April and September. And in fact, without the savings rate going down, because people feel more comfortable spending their after-tax income when they see their monthly statements, without that benefit of the stock market via the lower savings rate, which is the most powerful behavioral aggregate in the national accounts. Did you know that consumer spending in real terms would have declined 1.2% at an annual rate over the past 5 months? Instead, it's up 2.6, but not 2.6 because of organic income. Organic income is actually going down. When you look at real disposable income, it's been negative the past 5 months. If people were forced to spend based on their income, and of course, income is following this weakening labor market. If the savings rate had not gone down, courtesy of the ballooning stock market, 70% of GDP, otherwise known as the beloved consumer, would be negative 1.2. And I'll tell you, people would be talking about a recession again. So we've camouflaged a lot of things. The AI effect on keeping the economy at least flat, keeping the stock market in a bull market mode, and this pervasive belief that it's going to be continuing because it's the permanent income hypothesis, as per Milton Friedman, that drive spending. People have it in. You saw the number from the University of Michigan, right? This is actually, I mean, this is so fascinating when you're talking about dichotomies and divergences. That the University of Michigan Consumer Sentiment Index, which is now down, what, 3 months in a row, it's in the lowest 1% of all time. Oh, Adam, where'd you pick that? You're like Merlin the Magician. Um, so yeah, and
I
and
follow
and
your work, David.
well, the thing is that it's not just that, it's all the buying intentions components are in the bottom 5%. The employment components, worst 1% of all time. This is just, I mean, look at this chart. It goes back even further. This is University of Michigan. This is one of the soft surveys I was talking about. And then people say, but that's not GDP. Well, I got news for you. The reason why the NBER takes so bloody long to announce when we're in a recession is because they wait for all the revisions. And people bow down to the holy grail of GDP and non-farm payrolls. We see what non-farm payrolls did to the former BLS commissioner.
Right.
There's no data series, soft or hard, that's infallible. But the various components of this consumer sentiment index, you have the headline here. But if you go to the buying intentions, autos, housing, big ticket durable goods, if you go to the employment indicators, they're the lowest 5% of all time. In fact, what's really fascinating is that less than 40%, fewer than 40% of American households in the survey think they're going to get a wage increase in the coming year. Fewer than 40% think that they're going to be getting. Look at that. I mean, what does this picture tell you? Expectations of more unemployment. I got a question for you, Adam. People say to me, if I talk about a recession, like, look, I was being charitable. I said we're flatlining, okay? Because I don't want people to think, well, Rosenberg's just a complete idiot. But maybe it's worse than flatlining. I mean, this is household perceptions of the labor market has never been here before, without actually there being an NBER defined recession, although
Right.
maybe, just maybe it's different this time, if you want to go with that refrain. But the major point here in the dichotomy is that the income, spending intention, labor market components of this survey are in the lowest 5% of all time. The headline consumer sentiment is in the lowest 1% of all time. This thing goes back like 7 decades. But 56% of respondents are still bullish on the stock market. Did you know that? That's higher than the long run average. I'm talking about the real side economic components of this thing are horrible. They're scaling against the bottom of the historical range, but the pervasive belief in the stock market is above the long run average. That's never happened before. So there's some deep-seated, almost religious, fervent belief that AI is going to be the answer to all our prayers. And then at the same time, after all, who needs the labor market when you got the stock market?
Right.
And that's where I mean is that, you're asking some great questions. Your first comment was about these are confusing times. Now, I don't know if the stock market, sentiment component is in the little slides that you have there, but
I don't have that
yeah,
handy. Sorry.
but it's inverted, to the consumer confidence survey
Right.
itself and all the real side components. So there's a lot of divergences and dichotomies that I think in the next year are going to have to get resolved.
Okay. So I got a shorter term and then a longer term question for you about this. Shorter term, it sounds like you think for whatever trigger reason, the bloom may come off the AI bubble at some point. And we're already seeing it's rare that a week, sometimes even a day goes by where somebody pretty high up in the AI world doesn't say, you know what, this thing's in a bubble, right? Even Sam Altman said it, right? Um, so uh, let's assume for a moment that that does happen, where the market just steps back and says, okay, you know what, for reasons X, Y, or Z, we just don't think we think we pulled way too much of tomorrow's value into today, and it's going to take longer than we thought to get all the spoils from this. So we're going to need to put some material haircut on today's prices. What would you expect under that scenario? Would you expect .com price declines 60 to 80% in a lot of these companies? And then, what would the negative wealth impact have on the economy?
Well, I'm probably closer to 40 to 60 down than 60 to 80.
Okay.
And I say that because the valuations are extremely stretched, but they were more stretched back then. So as bad as it will be, the mean reversion of the multiple to the reality won't be quite as severe. But it still will probably be severe. And the one reason why it's going to be very problematic, maybe for the economy. Like my big concern is, what are the second round impacts? What are the societal impacts? And so we have to talk about the demographics. We talked about concentration risk. Yeah, we have, look, what do we have? Like $9 trillion stocks. Top 10 are like $9 trillion stocks.
Yep.
40% of the market.
I mean, I can think of three that are about 7 trillion together, right?
Yeah. So it's yeah, exactly. So it's and you've got the situation where over half the market now are these passive indexed ETFs, these S&P 500 uh, indices that track the S&P 500, these passive indices. Nobody needs an advisor anymore. Nobody needs a broker. They're lower cost, but over half the market is passive. And which means that, in the old days, you had a broker or an advisor, you had an active manager who would do the work for the retail investor. They would move you into cash, or they get maybe more sophisticated and maybe seeing the clouds coming in, instead of parting with the portfolio, maybe you just sell some call options against it,
Right. Buy some hedges.
or do some sector rotation to reduce the overall beta of the portfolio.
Yep.
Who's doing that for Mon Pa Kettle today? They're just blindly investing in this concentrated index, not even knowing what it is that they have in there. Like the era of doing any fundamental analysis, looking at balance sheets, income statements is over. Well, just by, and the reality is that, and this is where the hubris comes in, is that for the past few years, it's really worked well. So then extrapolation comes in, and I've seen this before. I've been doing this 40 years, and the danger at a bubble peak to extrapolate. Remember who did the extrapolating, no matter how smart you are, was Chuck Prince.
Right.
Back in June 2007, who told us we should just stay dancing till the music stops. But I don't even think he knew the music was going to stop 3 months later. So we have concentration risk in the market. We have concentration risk in the sense that over half the market now, John Bogle in the 1970s, I mean, the pioneer at Vanguard with the the Vanguard ETF, said this will never become more than 20% of the market. It's now over 50%. And then on top of that, concentration risk, layered on concentration risk, we have 72% of the US household financial asset mix in equities. Yeah, that's higher than we had in the late 1990s. That's a lot higher than it was back in 2007, but that was more of a housing and credit bubble than an equity bubble, but everything got caught up in it. All these markets are somehow correlated. Only 8% of the household portfolio, Adam, is in bonds, is in the stuff that Lazy Hunt and Van Hoysington do for a living. 8%. But like, who wants bonds? Really? Are you going to go to your neighbor's cocktail party and talk about your treasury position? I mean, don't you want to make friends and have people talk to you? I mean,
Mhm.
so boring bonds, 8%, 72%, the rest basically mostly in cash, 72%. But on top of that, I mentioned the demographics. Look, uh, over 60% of the baby boomer asset mix is in equities. It's
Right.
about
Which is
double what it should
ridiculous.
be. Well, you start to think that, so we're going to stress test this. That's what I mean is that I don't spend my time. No, I read it daily, so I'm into current analysis. However, the bulk of what I spend my day doing is thinking not about what are the headlines today or tomorrow. What will the headlines be 3, 6, 9, and 12 months from now?
Hmm.
That is what consumes me. When people say what keeps you up at night, it's what are the headlines going to say between now and the next 12 months? And I'm really worried. I'm worried about the complacency. I'm worried about the hubris. I'm worried about the fact that the reason we got to a 72% share of the asset mix in risk is because nobody took any profits, nobody took chips off the table, nobody diversified, nobody rebalanced in the past 3 years. That has me nervous. And we're going to stress test the system. When I say the system, I'm not talking about systemic risk. I'm talking about society. I'm talking about the fact that for the first time, now look, you know as well as I do, we will have a bear market. The market cycle's not dead. The business cycle's not dead. Mother Nature is not dead. And I don't know when the next bear market's going to start. I know that we're a lot closer to it today than we've been any other time in the past 3 years. And what has me nervous is the positioning of the general retail investing public. And when I talk about this to people in a room, Adam, their eyes just glaze over or they're looking out the window. And but the median age of the boomer is 70. Okay. Back in the tech wreck, it was 45, 70 today. The first of the boomers are turning 80, and they have way too much risk.
And way too little
And
time to
time
recover from a bear market.
they're not my kids, right? In their 20s and 30s. Like time is not on their side. So a lot of stuff is going to happen. Okay. And don't forget what stress will this put on the social security system when people see that they'll have to recalibrate their golden years in retirement to a totally different lifestyle expectation than they have on their minds right now. That's going to have, you see, and the problem here is that as an economist, you're always thinking about second round impacts. I think I'm probably, tell you the truth, more worried about the second round impacts of the stuff I'm talking about right now than I am about the impact of the overinvestment in AI, which of course is natural. If we don't get overinvestment, haven't seen it already, it's the first time that's ever happened because that is the natural fallout from this type of a shift we have in the technology curve. There's nothing we're seeing, Adam, that we haven't seen before, right? I think that's true. And so, ergo, it's going to play out much the same. It's just that from the demographics and the concentration risk on household portfolios, especially the boomers, the 78 million pig in a python, that's driven everything in our lifetime, right? From politics to economics to finance. Well, we're going to stress test society, and then there'll be second round impacts. This is what could cause this when we get the recession and the bear market could cause a double waterfall from the impact this is going to have on the savings and spending function for a very wide swath of the population called the baby boomer class, of which I'm one of them. I'm just not positioned the way everybody else is.
All right, so this is a rich vein here. So um, you're warning of us sort of sleepwalking into the next bear market. We're not, as you said, you try to warn people about it and their eyes just glaze over because, David, of course, the market's just going to go up forever. And as a baby boomer, why wouldn't I have even more of my wealth in the stock market because it only goes up, right? Um, so I totally get the risk that you're talking about there, and the ripple effect that would have across the economy. And one of the things I've sort of warned people about too is like we talk about this massive wealth transfer that's going to happen from the boomer generation to their children, and that will happen. But I'm not sure that wealth transfer is going to be nearly as big as everybody's counting on for two reasons. One, a lot of it could get vaporized in what you're talking about, should that happen. And then secondly, with costs of all sorts of things going up, especially medical care and end-of-life medical care, and the boomers seem to be really enjoying spending this money,
Mm.
there just might be a lot less left over of the 80 trillion or whatever it is right now. Maybe only 40 trillion gets passed along. It's still a lot, but it's not nearly as much as right now everyone's just assuming is going to make the transfer. So I do agree that's a really big risk. Let me ask my longer term question for you, which is, in addition to that risk, right now, the societal trajectory is that that top 10% is taking more and more of the spoils, right? So even though the economy is, you know, flattish right now, to more and more people, it feels recessionary, right? Yet we haven't had, the large unemployment, large job layoffs and stuff that we might get if we end up going into the type of recession you think could ensue from the popping of the AI bubble. Um, but let me ask you this. With that being sort of the trajectory where this K-shaped economy has fewer and fewer people at the top with more and more of the spoils, and so more and more of the people at the bottom get less and less of the fruits of the economy. Um, and let's assume AI does what it's everyone expects it to do, which is to start really displacing labor, right? How worried are you about kind of the trajectory of society here, where it does seem to be becoming increasingly, even in capitalist societies like America and Canada, that it's really becoming a system of haves and have-nots, with fewer and fewer people being fortunate enough to be in the haves category?
Well, I think that you made a really great point. And this K-shaped economy that you're talking about has been with us for decades, and it's getting worse. No, I might be Canadian, but I'm a hardcore capitalist. Okay, I'm a capitalist with a heart,
Hmm.
but I am a capitalist, and want to be very careful that you don't get to extremes. When I talk about income or wealth inequalities to people, they get the wrong idea. They think I'm turning into a socialist. But, democracy and capitalism are always dancing on a very tenuous pin.
Hmm.
And it's a very fragile relationship. I mean, look what's happening. Look at the New York mayoral race.
Mm.
And that's spread. It's going to spread. You're seeing it in other cities too. There is a wide divide in the United States, and you once again can't extrapolate between Donald Trump and the Republicans in power in Congress today to what that's going to look like 2 or 4 years from now. And so when you're looking at what's happening in New York City, and imagine that we would have ever had, and Madami's going to win, probably in a landslide. I think it's too late. People have made up their minds. A socialist mayor in the world's financial capital. I mean, you and I have been talking about extremes and divergences throughout this whole call. Think about that for a second, and then think about where that's going to lead us. But think about what brought us here. And frankly, I got a lot of hate mail from a report that I wrote several months ago because I was always a Ronald Reagan disciple. And I was looking through reams of data post World War II. And I was always a big advocate for Ronald Reagan and for the tax reform, and I would say that I was probably wrong uh, on that aspect of it. Because it was in the early 80s where that income disparity really started to accelerate. And it didn't matter who was in office, Democrat or Republican, it just kept on going under Bill Clinton. Did Bill Clinton, cut capital gains taxes with Bob Rubin. And under Obama, Obama had, I think, more Goldman Sachs people in his cabinet than any other president in history.
Hmm.
And we got Donald Trump, who's it's hard to really pin him as in any specific corner, but the first thing he did when he got into power in Trump 1.0 was go through this huge corporate income tax cut, which everybody loved. The point I'm making is that up until Reagan got elected, and you looked at productivity growth per year from like 1950 to 1986, which is when the Tax Reform Act was passed. And productivity growth averaged 2% per year, and real wages averaged 2% per year. So the proletariat were at least getting their marginal returns from the sweat they were putting in. They were getting paid their productivity. And the owners of capital were getting an annualized growth of 2% per year in real terms. So everybody was sharing in the spoils equally, owners of capital and labor. And then something happened in the mid 1980s. Okay, so when we're talking about something that's not new, it's just when you compound things every year for 4 decades, it gets too big to manage. So what's happened is that since the mid 1980s, and it's getting worse, is that productivity growth hasn't slowed, without the internet or Microsoft going public and all the Apple iPhones. What are we up to? 200
Right.
of them. Productivity growth since the mid 80s has averaged 2% per year.
Right. But the
But real
spoils
real
shifted.
work-based pay has only gone up 1% per year.
Exactly. Yeah.
So what's happened is that's why when you look at these things called, like economists look at labor market experts, look at Gini coefficients, these classic measures of income inequality, it's out of control. It has me nervous because we've hit an extreme. And so there's something wrong, I gotta say, with the compensation, incentive, and tax system. And it's going to blow up. And you're 100% right. So now we have the situation where um, you got this not just K-shaped, this is capital K. And
Yeah.
this is not a time to put your CFA hat on, okay? This is a time to understand history and to understand the fragile relationship between capitalism and democracy, right? And we can't let things as capitalists. You see, this is exactly what Marx and Engels were talking about, okay? They were talking about that capitalism will end up eating itself. And once again, this is tough to a Wall Street crowd. This is a tough message. We want our spoils, but it's reached a level of unevenness that is really unhealthy and unstable. And so, as it stands right now, 100% right. I mean, you're seeing it, like I said before, what's driving the economy right now is the stock market. I made a mistake before. I said the S&P is not the GDP. Well, the S&P, the wealth effect on spending, is virtually unprecedented. That's what I said before. The savings rate's dropping like a stone because people believe that the stock of equities, and this is in a certain percentage of the population, is going to be their golden goose, and I'm going to spend all my income now. And that's how you get this Potemkin village, this illusion that we've got this consumer resilience in an environment. And I say this over and again, consumer resilience in an environment where real disposable income, think about that, real disposable income, and a lot of that income is what what politicians call the quotes, the hard-working American. It's, that's how you run your campaigns on. Real incomes are going down. Now, part of that, I think, is, of course, that inflation stopped falling at the margin. Maybe it's gone up or it's been stable, but nominal incomes are disinflating. So real incomes after tax have been going. Most people don't even know that. They don't even know that real after-tax income from April to today has actually been negative. But yet consumer spending has been positive 2.6 at an annual rate, not a small number, because of the wealth effect from the
That's the
stock
K
market.
shape right there. Yeah. That's the top of the K driving that. Yeah. So, all right, David. Well, look, I very much appreciate you going into this territory with me, and we could talk about it for a lot longer. And actually, if you don't mind, maybe next time you come on, we'll reserve a little bit more time to talk about sort of, you know, if you were in charge, what type of reforms you would like to see to keep capitalism from going off the rails here. I'm sort of thinking of you as a capitalist with a heart who'd like to keep his head, right? And
unlike
so how do
unlike Marie Antoinette.
exactly. So how do we all make sure that this doesn't end up in a French Revolution style ending here? And I just want to note too, everything you're saying is if the status quo trajectory continues, and I asked you a question which we don't really have time to get into, but is what if AI delivers on its promise of like replacing millions of workers, right? It just makes things way even worse, right?
It definitely does, and and I've been writing about it, Adam. Just quickly, AI is not going to increase output. When we're talking about increase, AI is not making us smarter, right? Um, it's not making us smarter. Do you know that I've got my own staff telling me that they have they're seeing, I'm not going to say who, but other people that they could tell they run these, I know, these models that can tell how much of a paper was written by AI. Do you
Yeah.
know this? You can actually tell. Um, it's making it's speeding us up. It's making us faster. Okay. AI is not making us smarter. When they talk about the productivity boom, it's not about that output is going to be accelerating. It's the denominator. It's going to be labor saving, labor saving. And that
Hmm.
was the one thing I got to say in that University of Michigan index. And I don't think I had the chart ready for you. However, 1 in 5 Americans now fear a job loss over the next 5 years. So what's keeping this glue together for the consumer is that top 10% being fueled by the stock market. Outside of that, we probably would be in a consumer recession right now.
All right. Well, okay. Well, look, just to get down to brass tacks here, which is we don't know whether we're in early 1999 or heading into 2001, right? So does the party in the stock market continue for another year plus from here or not? So how does all this in your mind translate into, is there an investing strategy that you think is appropriate given the moment we're in, given what we know?
Yes, there
Because
is.
I don't get the sense from you, it's
Well, I
like
don't.
time to
Well, the
get,
thing is that I look, I don't. It's like if somebody says, let's say your great grandfather said, "I got out of the market in 1928." Would you say to him, you're such a moron. You missed the last leg in
right,
1929. You're such an
right.
idiot. But if I told you, like the thing is that when I was at Merrill, I was a goat. Then I was a hero, but I was 2 years early. But there's the thing about bull markets, and you build up the hubris over time because bull markets are escalators going up over time, and bear markets are elevators that just go straight down. And then we got the two, because we're talking a lot of we spend most of the time talking about big picture things and fundamentals and divergences and dichotomies. Sentiment is so important. Human behavior. I'll tell you the one thing AI is not going to change any more than the internet changed, or anything more than transistors changed or semiconductors, is these two basic emotions of fear and greed. And I'll tell you, after spending time at Mother Merrill in 0809 in Midtown, that fear is a more primal greed. But we are in Gordon Gekko right now. I'm going to tell you right now, nobody's going to be able to time this thing. I am playing the Baron Nathan Rothschild, playing the middle of the cycle. I played the middle of the cycle. And no matter what your view is on what inning we're in, Adam, we are not in the middle 60%. So
Mm-hmm.
I definitely am not recommending people right now chasing nickels in front of the steamroller. Okay, no, I would not be doing that. But if you don't want to part with your beloved portfolio, people fall in love with your portfolio. I say fall in love with your partner, your portfolio, like your forecast won't always love you back. But I'd say I would be selling call options. If I don't want to sell my equity portfolio, sell call options. Other than that, do some sector rotation to at least get the beta, cyclicality, and risk down. That means maybe having more of a focus on utilities and consumer staples and healthcare. I have no problem with that. I think I like the treasury market. I think bond yields will be going down. The yield curve will steepen. I think that in the next year, actually, when you look at the convexity and how far rates can come down across the curve, you probably could make 10% in the bond market. I got to tell you, Adam, when I tell people you can make 10% in the bond market, when I tell that to people today, you know what they say to me?
They yawn.
Is that all you got?
Yeah.
And I would be saying, look, we're going through a very much needed correction in gold and silver right now. It probably is going to continue, but that is a secular bull market. You're going to, for those people that were kicking themselves and missed there's been multiple legs. I mean, the bull market in gold actually started in late 1999 with the Washington Agreement. This has been a long secular bull market in gold, just people recently have woken up to it. But I think that a lot of the work we've done is saying that gold, the peak in gold will go to or through $6,000 an ounce. I got my reasons why. Silver will go along for the ride. We like the precious metals complex. You're getting another opportunity right now, so you can actually, I think, add some exposure to gold and silver and the miners during this corrective period. I'd say that don't be zero weight equities. I'm not zero weight equities. I just have a very low weighting, and it's very concentrated in the most defensive parts of the market. And I'd be diversifying geographically too. The valuations, when I'm talking about there being bubbles, there's no bubble in Japan. I'll tell you right now, Japan, with this new coalition government, because we were in the Japanese equity market, we took profits several months ago. Now we're looking at getting back in. There's other parts of the world that look very interesting to us. Global aerospace defense, that's got visibility. That's an area. Canadian pipelines. So I think what you want to do is get out of your passive ETFs, which is just blind investing. You don't want to be doing that anywhere close to a peak. And when I define close, I don't care if it's within a year. Be thematic and invest in your highest conviction ideas and in areas that have visibility that won't kill you if the AI trade rolls over or we go into a bear market. So I would say just basically manage your risk. Manage your risk. That's the problem with this passive ETF investing. The
Mm-hmm.
era of managing risk. I almost feel like telling young people, why do your CFA? They teach you about risk-adjusted returns. People don't care about that. They care about gross returns and driving 300 miles an hour down the freeway. That is not how you build wealth over time. And I would just say one other thing. Survival's kit to investing in a bubble is make sure you have liquidity. Have liquidity because every bubble bursts. I am 99.999% convinced we are in a market bubble. It's a price bubble. At some point, the pin will prick the bubble. This is how it's played out over the millennia. And it's the people that have the liquidity that can pick up the pieces at the bottom.
That's your Baron von
That end up,
Rothschild
well,
flooding the
that's how you
streets.
build that. Well, that is how you build wealth over time. You're not trying to time the market, but you're trying to, at least, like I said, nothing's black or white, but you got to play the shades of gray. And as I said, the wind, when you're at a 2SD multiple across the board,
Mm-hmm.
The wind's in your face. Make sure that you have a liquidity buffer. Okay, I would suggest that. I'm not going to time it, but in the next 12 months, you're going to wish that you did.
Okay. And just to bring it back to Baron von Rothschild again, so he said play the middle of the cycle. That's how you get rich
Yeah.
over time. He's also the one though who said buy when there's blood in the streets, and that's
Yeah,
you can only do if you have liquidity.
that's 100% right. Yeah. Play the middle 60%. That is prudent, diligent investing. It's hard to preach because of the Gordon Gekko factor, right? Um, and the extrapolation, which you always get at bubble peaks into the future. And we're living it. Look, it's not as if look, I haven't been doing this 400 years, but I've been doing it for 40 years. So I've been through this rodeo before.
Hmm.
So I'd say that there's ways you can protect the portfolio without having to sell everything. There's ways that you can influence the beta and cyclicality of the portfolio without actually having to take down your equity position. Just reposition within your existing position. But I would say bonds. I would be hiding in bonds. When I hear people saying 10%, you expect 10% in the total return in the 10-year Treasury, and I get back that's all you got, that is when you know that we are in a really funky, unsustainable, sentiment driven market environment.
All right. Well, we will have to leave it on there. David, thank you so much. Folks, please express your appreciation for David giving so much of his overall analysis, but also really detailing out a great way to stay risk managed in a highly uncertain and perhaps a vulnerable market like this. But please show them that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. David, I can't thank you enough, my friend. Great job this time. And look, we'll have you back on either very late this year or early in Q1 to kind of call an audible for us on where you see things.
Excellent.
All right. Very much appreciate it, my friend. Everybody else, thanks so much for watching.